March 10, 2023. Silicon Valley Bank, the 16th largest bank in America, with $209 billion in assets, collapsed in less than 48 hours. Customers withdrew $42 billion in a single day. The stock went from $267 to literally zero. Not $10, not $1, zero. 3 days later, Signature Bank followed, then Credit Suisse in Switzerland, a 167-year-old institution gone, absorbed, erased from existence. And here's the part that should terrify you. This has all happened before, not just once, not twice. Over and over again throughout history, following the exact same pattern, with the exact same assets getting obliterated, and the exact same assets surviving. The financial media wants you to believe each banking crisis is unique, a black swan, unpredictable. But I've analyzed every major banking crisis in the last 150 years, and there's a pattern so obvious, so predictable, that once you see it, you'll never look at your portfolio the same way again. Today, I am going to show you the 5 assets that have survived every single banking crisis since 1873, and more importantly, I'm going to show you exactly what went to zero, what vanished overnight, and what turned life savings into nothing but a footnote in bankruptcy court documents. Because if history has taught us anything, and it hasn't, because we keep making the same mistakes, it's that the next crisis isn't a question of if, it's a question of when, and whether you're positioned on the right side of this pattern, or the catastrophically wrong side. Let's start with what just happened, because 2023 wasn't ancient history. It wasn't your grandfather's depression. This was your money, your banks, your retirement accounts. 18 months ago, Silicon Valley Bank was the darling of the tech world. Half of all U.S. venture capital-backed healthcare and technology companies banked there. Airbnb, Cisco, Pinterest, Block. If you were a startup, you banked at SVB. On March 8, 2023, they announced they were selling $21 billion in securities and booking a $1.8 billion loss. They needed to raise $2.25 billion in new capital. March 9th, panic begins. Depositors start withdrawing funds. March 10th, bank run. $42 billion withdrawn. California regulators closed the bank. Total time from announcement to death, 48 hours. A $209 billion institution gone. In 2 days. If you owned SVB stock, zero. If you owned SVB bonds, pennies on the dollar, maybe. If you had uninsured deposits over $250,000, you were praying to the FDIC gods for mercy. But SVB wasn't alone. The banking turmoil that started in March 2023 was the most significant system-wide banking stress since the Great Financial Crisis. Over 11 days from March 8th to 19th for banks with total assets of about $900 billion were shut down, put into receivership, or rescued. Let that sink in. $900 billion, almost $1 trillion in banking assets, gone, absorbed, or on life support in less than 2 weeks. And you know what caused it? The exact same thing that caused the 2008 crisis, and the savings and loan crisis in the 1980s, and the bank panics of 1930-31, and the panic of 1873. The same damn thing, over and over, like financial Groundhog Day. Banks took deposits. They invested in safe long-term securities. Interest rates rose sharply. Those safe securities lost massive value. Depositors panicked. Everyone wanted their money at once. Banks couldn't meet the demand without selling those securities at huge losses. Game over. During the 2023 crisis, U.S. banks held $515 billion in total unrealized losses on securities investments. By the end of 2024, that had grown to $482.4 billion, and after April 2025's bond yield spike, it's probably worse. That's $500 billion in losses sitting on bank balance sheets like a ticking bomb, waiting for the next match. But here's what the financial media isn't telling you. While Silicon Valley Bank shareholders watched their investments evaporate to zero, while Credit Suisse bondholders got wiped out, while depositors sweated bullets wondering if they'd ever see their money again, other assets did just fine. Better than fine, actually. During the height of the 2023 banking panic in March, gold prices surged. U.S. Treasury bonds, the short-term ones, rallied as investors sought safety. The dollar index showed mixed but generally stable performance. Sound familiar? Let's rewind to 2008. Lehman Brothers, 158 years old, $639 billion in assets, filed for bankruptcy on September 15th. If you owned Lehman stock, zero. If you owned Lehman bonds, the Reserve Management Corporation revalued its Lehman securities at zero and announced it could no longer redeem shares in its money market fund at par value, breaking the buck. For the first time in history for individual investors, $3.5 trillion in money market funds, supposedly the safest place besides a bank, suddenly looked shaky. Shares worth less than $1. Your safe money, not so safe. Washington Mutual, the largest savings and loan in America, with $307 billion in assets, collapsed. If you were a WAMU shareholder, your stock went from double digits to pennies, then effectively zero. Bear Stearns stock went from $170 share to $2 share overnight, eventually $10 after negotiations, but still a 94% loss. IndyMac Bank failed. Hundreds more followed. The FDIC closed 465 failed banks from 2008 to 2012. In the 5 years before 2008, only 10 banks failed. And those mortgage-backed securities that banks were holding, the ones that were rated AAA, safe as houses, collateralized debt obligations, CDOs, CDO squared, subprime mortgage bonds. Once the housing bubble popped, these assets were worth anywhere from 0 to pennies on the dollar. 0 to pennies. But while all this was happening, while the financial system was supposedly ending, while economists were predicting a new Great Depression, while the S&P 500 fell by over 37% in 2008, gold rose by nearly 25%, U.S. Treasuries gained 17%. Pattern. There's that word again. Let's go further back. October 29, 1929. Black Tuesday. The day the stock market didn't just crash, it cratered. 16.4 million shares traded. Panic selling. Fortunes erased. But that was just the beginning. After the panic of 1929 and during the first 10 months of 1930, 744 U.S. banks failed. By the end of the 1930s, 9,000 banks had failed. 9,000 banks. Of the roughly 24,000 banks operating in January 1929, only about 14,000 remained when the banking holiday began in March 1933. By April 1933, around $7 billion in deposits had been frozen in failed banks or those left unlicensed. In 2023 dollars, that's over $160 billion in frozen deposits. If you were a bank shareholder during the Great Depression, the bank stock index rose from 100 in January 1920 to 709.73 in September 1929, a 609.73% increase. Then it fell more than 87% from September 1929 to May 1932. If you held on, hoping for a recovery, by 1939, bank stocks remained well below their 1929 peak. It would be decades before the market capitalization of financial intermediaries surpassed their high point in 1929. Decades of waiting. If you had your money in a failed bank, you might get some of it back. Eventually, maybe. Or you might get nothing. One report from the era mentioned a farmer's great-aunt who survived only because she had chickens and sold eggs. That was the cash crop. Acres of corn weren't worth anything. Dozens of eggs cost only 13 cents in 1933. Down from 50 cents in 1929, and almost 75% price collapse. If you were holding agricultural commodities, inventory, or business assets, you watched their value evaporate. And here's that pattern again: some assets did just fine. Cash became king. Those who held physical currency could buy assets for pennies on the dollar. And gold? Well, that's where things get interesting. In 1933, President Roosevelt made it illegal for Americans to own gold, forcing them to sell it to the government at $20.67 per ounce. Then surprise, the government revalued gold to $35 per ounce in 1934. If you'd managed to hold onto gold outside the U.S., you just made a 69% gain while everyone else lost everything. So now you're seeing it, right? The pattern. Crisis after crisis, the same assets get destroyed and the same assets survive. But which ones? That's what you're really here for. Let's talk about the shiny metal that everyone loves to hate until everything goes sideways. Gold. The barbarous relic, the pet rock, the thing that Bitcoin brothers swear is obsolete and financial advisors tell you to avoid because it doesn't generate income. And this is the part they always leave out: gold has outperformed during every single major banking crisis in modern history. Let's run the numbers. Because numbers don't care about your feelings or your financial advisor's commission structure. 2008 financial crisis, S&P 500 fell 37%. Gold rose 25%. 2020 COVID panic. In March 2020, when stocks swung over 10% in a day, gold stayed relatively stable, then hit all-time highs by August. Dot-com bubble 2000-2002. Tech-heavy Nasdaq lost nearly 80% of its value. Gold remained stable and began rising during later stages. 1970 stagflation. While stocks struggled, gold soared. The barbarous relic that doesn't generate income absolutely crushed it when inflation was rampant. From 2000 to 2024, if you put $1 into gold, you'd have about $6.82. The same dollar in the S&P 500 would be around $2.34. Gold won by a lot. But here's the really interesting part, and this is what separates smart money from dumb money. During periods of market turmoil and large equity drawdowns, gold has provided an average 7.18% return, while the S&P 500 pulled back minus 23.48%. Read that again. When the market tanked by an average of minus 23.48%, gold was up 7.18%. Black Monday 1987. Stocks plunged 19%. Gold gained 2%. LTCM crisis 1998. Stocks fell 19%. Gold rose 2%. Dot-com crash March 2000. March 2001. Stocks fell 24%. Gold rose. Post 9/11 recession March 2002. July 2002. Stocks fell. Gold rose. 2008 financial crisis October 2007. February 2009. Stocks plummeted 49%. Gold rose 47%. European debt crisis wave 1 2010. Stocks fell 12%. Gold rose 7%. European debt crisis wave to 2011. Gold rose 31%, outpacing both stocks and bonds. See the pattern? When banking crises hit, when the financial system looks shaky, when depositors start worrying about their banks, gold goes up, not because it generates income, not because it has a PE ratio or pays dividends, but because it's the one asset that can't be printed into oblivion, can't default, can't declare bankruptcy, and can't be hacked. And here's the kicker that should tell you everything. Central banks bought 244 tons of gold in Q1 2005 alone. Central banks, the institutions that create money, are buying gold. Think about that. They can print dollars, euros, yen, but they're buying gold. What do they know that you don't? Between 2020 and 2024, central banks of BRICS member states purchased more than 50% of global gold. Half of all gold being bought by central banks went to countries actively trying to reduce dollar dependence. If gold is such a terrible investment, such a barbarous relic, why are the smartest money managers in the world the ones who literally control national economies loading up on it? But gold isn't the only survivor. Here's something that might surprise you. U.S. Treasury bonds, specifically the short-term ones, have survived every banking crisis. Not corporate bonds, not mortgage-backed securities, not municipal bonds from your local government. U.S. Treasury bonds backed by the full faith and credit of the United States government. During the 2008 financial crisis, when everything was on fire and Lehman was worthless and money market funds were breaking the buck, U.S. Treasuries gained 17%. During the dot-com crash, U.S. Treasuries rose 13%. During the COVID panic in March 2020, when stocks were plummeting, what did investors buy? Treasuries. So many treasuries that yields collapsed, which means prices soared. It's called the flight to safety. When the financial system looks shaky, money flows into U.S. Treasuries so reliably you could set your watch by it. During the March 2023 banking crisis, U.S. Treasury and German bond yields collapsed. Falling yields means prices rose because of a surge in demand, as investors sought safe haven assets. But and this is crucial, not all treasuries are created equal. Short-term treasuries 3 months to 2 years are the gold standard of safety. Long-term treasuries 10 to 30 years, they can get hammered when interest rates rise. Just like what happened to Silicon Valley Bank. Remember SVB? They invested heavily in long-term bonds. When the Fed raised rates rapidly, those bonds lost massive value. SVB had invested more than 90% of its held-to-maturity portfolio in mortgage-backed securities, municipal bonds, and treasuries with maturities of more than 10 years. When they had to sell to meet withdrawals, boom, losses crystallized, bank dead. Short-term treasuries don't have this problem. They mature quickly, so interest rate risk is minimal. In the 2008 crisis, T-bills, the shortest-term treasuries, actually performed well as a safe haven. During the Great Depression, One of the few ways to preserve wealth was holding government bonds. Cash and short-term government securities were the safest harbors in the storm. Now, do treasuries make you rich? No, they barely keep up with inflation most of the time. But that's not the point. The point is capital preservation during chaos, when banks are failing, when stocks are crashing, when your neighbor's investment portfolio is getting obliterated. Treasuries keep your principal intact. It's not sexy. It won't make you a millionaire. But it also won't make you broke when everyone else is panicking. But there's an even more basic survivor. Cash, cold, hard, physical cash. The stuff your grandparents kept in a mattress because they lived through the Depression and never trusted banks again. Were they crazy? Or did they know something we've forgotten? During the Great Depression, the banks that failed took their depositors' money with them, at least temporarily. Between a third and half of all U.S. financial institutions collapsed, wiping out the lifetime savings of millions of Americans. If you had physical cash, not a bank balance, but actual dollar bills, you could spend it. You could buy assets from desperate sellers for pennies on the dollar. You had liquidity when liquidity was the most valuable thing on earth. During the 2008 crisis, there were genuine concerns about ATM availability. If your bank failed before FDIC insurance kicked in, or if you had uninsured deposits over $250. Having physical cash was the difference between okay and catastrophe. In March 2023, SVB depositors who couldn't access their funds were panicking. Payroll couldn't be met. Bills couldn't be paid. Cash suddenly became incredibly valuable. And this is a huge but cash has a fatal flaw that gets worse every time the government solves a crisis. Inflation, devaluation, the slow, steady erosion of purchasing power. $1 in 1929 is worth about $18.25 in 2024. That's a 94.5% loss of purchasing power. If your great-grandfather had hidden $10,000 in 1929 cash and you found it today, congratulations. You have the equivalent of about $182,500 in purchasing power. Or you would, if it was still 1929. But since it's now, you actually have $10. That buys what $548 bought back then. From 2020 to 2024, we saw 20% plus cumulative inflation. That $100 you saved in 2020, it buys about $80 worth of goods today. So cash is a survivor. But it's a survivor that slowly starves to death if you hold it too long. Cash is for liquidity in a crisis, for buying opportunities when assets are on fire sale, for having options when banks are closed and ATMs are empty. Cash is not for long-term storage of wealth. That's what the other assets on this list are for. The people who thrived during the Great Depression weren't the ones who hoarded cash under their mattress forever. They were the ones who held cash during the panic, then deployed it when assets were cheap. Buy real estate for pennies, acquire businesses, purchase stocks at Depression-era lows. That's the play. Liquidity during chaos, deployment when the dust settles. Now let's talk about the two assets that surprise most people. Wait, stocks. Stocks survive banking crises. Not quite. Let me be very clear about this. If you panic sold during the 2008 crash, you lost. If you sold near the bottom in March 2020, you lost. If you bailed out during the 1987 crash or the dot-com bubble, you got destroyed. But if you held diversified blue-chip stocks, the boring companies, the ones that make stuff people actually need and you didn't sell, you not only survived, you thrived. The S&P 500 has recovered from every single crash in history. Every single one. The 1987 crash recovered within 2 years. The 2000 dot-com bubble took longer, but recovered. The 2008 financial crisis? By 2013, the market was back to pre-crisis highs. The 2020 COVID crash recovered in months. If you had invested $1 in the S&P 500 in 1929, literally the worst possible timing, right before the Great Crash, and held through the Depression, World War II, the 1970 stagflation, the 1987 crash, the dot-com bubble, the 2008 financial crisis, and COVID, that dollar would be worth over $10,000 today. $10,000. Companies like Coca-Cola, Procter & Gamble, Johnson & Johnson, the boring dividend payers, the ones that make toothpaste and soap and stuff people buy. Regardless of whether the economy is booming or crashing, these companies survived the Great Depression. They survived 2008. They'll survive the next crisis. But here's the critical distinction. This only works if you can hold through the pain. In 2008, The market fell 57% from peak to trough. If you sold at the bottom, you locked in massive losses. If you held, or better yet, bought more, you captured the entire recovery and then some. The people who got rich from the 2008 crisis weren't the ones who sold everything and hid in gold. They were the ones who had gold and cash as a cushion, so they could hold their stocks without panic selling. Diversified. That's the key word. Not tech stocks only. Not bank stocks only. Not one sector. Broad exposure to quality companies across multiple industries. Because some stocks do go to zero during banking crises. Which brings us to the fifth and final survivor. And then the massacre. Physical real estate, and I mean the actual property. The dirt and the building. Not rights or mortgage-backed securities, has survived every banking crisis. With a massive asterisk. If you were leveraged during the Great Depression, meaning you had a mortgage and you lost your income, the bank foreclosed, you lost the property. Game over. If you were leveraged during 2008 and couldn't make payments, foreclosure. Millions of them. But if you owned property outright, with no mortgage, or with manageable debt you could service, that property retained value. Maybe not immediately, maybe not at peak prices, but land and buildings don't go to zero. Yes, prices fell, in some areas dramatically, but a house is still a house. Commercial property still generates rent if you have tenants. Land is still land. From 2006 to 2011, home prices fell about 33% nationally. Painful. But compare that to bank stocks that fell 87%, or Lehman Brothers that went to zero. And by 2016, prices had recovered to pre-crisis levels in many markets. Over the long-term decades, real estate in good locations appreciates. It's tangible, it's useful, it's not going anywhere. But and these are big buts. Location matters immensely. Detroit real estate in 2008, catastrophic. Manhattan real estate recovered quickly. Leverage kills. If you're over-leveraged and can't service the debt during a crisis, you lose everything. REITs are not physical real estate. Real estate investment trusts are stocks. They trade like stocks. They crash like stocks. During the 2008 crisis, many REITs got massacred. Down 70%, 80%, some approaching zero. They're fine in normal times, but in a banking crisis, they act like stocks, not property. Physical property that you own, that generates income or provides shelter, that you can hold through volatility, that's the survivor. And just like with stocks, the best time to buy real estate is during the panic, when leveraged sellers are desperate and prices are depressed. But you can only do that if you have cash or gold to deploy. Which brings us full circle to the pattern. Now that you know what survives, let's talk about what turns into toilet paper. Let's start with the obvious one. Bank stocks. Silicon Valley Bank, Signature Bank, First Republic, Credit Suisse, Washington Mutual, Bear Stearns, Lehman Brothers, IndyMac, Wachovia, WAMU. The list goes on and on and on. From 2008 to 2012, the FDIC closed 465 failed banks. Between 1980 and 1994, a U.S. bank failed every 3 days. During the savings and loan crisis of the 1980s and 90s, almost a third of S&L institutions were taken over by regulators. The Resolution Trust Corporation closed 747 S&Ls with assets of over $407 billion. During the Great Depression, 9,000 banks failed. The bank stock index fell more than 87% from September 1929 to May 1932. Silicon Valley Bank stock, $267 to $0 in 48 hours. Lehman Brothers, from $60 share to bankruptcy filing. Bear Stearns, from $170 share to $2 share briefly. Then $10 after JP Morgan bought them a 94% loss. Washington Mutual, from a functioning bank to worthless stock. In 2023, before SVB collapsed, anyone could see a huge amount of its assets were in held-to-maturity securities that were underwater. But shareholders, bondholders, and depositors ignored the warning signs. Then poof, gone. Here's the pattern you need to understand. Banks are leveraged. They take deposits, money they owe you, and invest them in longer-term assets. It's called maturity transformation, and it works beautifully, until it doesn't. When interest rates spike, the value of their long-term assets collapses. When depositors panic, they need cash immediately. When banks have to sell those underwater assets to raise cash, they realize losses. When those losses wipe out capital, bankruptcy, and banks are interconnected. When one fails, it creates fear about others. Bank runs can become self-fulfilling prophecies. In 2008, after Lehman fell, every bank looked suspect. Credit froze. The financial system nearly collapsed. Banks that were actually solvent got hit because investors assumed everyone was hiding the same problems. And remember those $482.4 billion in unrealized losses sitting on U.S. bank balance sheets right now. That's the loaded gun. All it takes is rising rates or a confidence crisis to pull the trigger. Bank stocks are not survivors. They're victims. Every single time. If you own regional bank stocks right now, you're not diversified. You're not positioned for safety. You're holding a lottery ticket that pays off in good times and goes to zero in bad times. But it's not just bank stocks. Let us talk about one of the greatest scams in financial history. Securities that were rated AAA supposedly as safe as U.S. Treasuries that went to zero. Mortgage-backed securities. Collateralized debt obligations. CDO squared. The alphabet soup of financial engineering that nearly destroyed the global economy in 2008. These weren't some sketchy penny stocks. They were rated AAA by Moody's, S&P, and Fitch, the most prestigious rating agencies in the world. Banks, pension funds, insurance companies, foreign governments, everyone bought them because they were safe. The logic seemed sound. Home prices always go up, right? These securities were backed by thousands of mortgages. Even if some people defaulted, the diversification would protect you, except many of these mortgages were subprime, liar loans, no documentation, no income verification, no down payment. People who had no business getting a mortgage were getting mortgages when home prices stopped going up and started falling. Defaults skyrocketed. The securities backed by these mortgages became toxic. Collateralized debt obligations, CDO squared. Once the housing bubble popped, these assets were worth anywhere from 0 to pennies on the dollar. 0 to pennies. In 2007, two Bear Stearns hedge funds that invested heavily in these securities collapsed. Investors lost nearly everything. That was the canary in the coal mine. Banks had billions in these securities on their balance sheets. As values collapsed, banks had to take massive write-downs. This wiped out capital. This led to failures. Lehman Brothers had heavily invested in subprime mortgages and other risky financial products. When their values plummeted, Lehman faced mounting losses and a severe liquidity crisis. Tens of billions of dollars in overvalued assets became worthless. The lesson: AAA ratings mean nothing when the underlying assets are garbage. Rating agencies get paid by the companies issuing the securities. Conflict of interest much. Today, we have junk bonds, high-yield debt, corporate bonds from over-leveraged companies. In good times, they pay nice yields. In bad times, when companies can't refinance or meet obligations, they default. Bondholders get pennies on the dollar. If anything, shareholders get zero. During every banking crisis, highly leveraged corporate debt gets crushed. But wait, there's more. Here's something that'll keep you up at night. Not all bank deposits are created equal. The FDIC insures deposits up to $250,000 per depositor, per insured bank, per ownership category. Notice what's missing: anything above $250,000. During the Silicon Valley Bank collapse, 94% of deposits were uninsured. Most depositors were startups and tech companies with millions in their accounts. When the bank failed, that money was frozen. Payroll couldn't be met. Bills couldn't be paid. Panic. The government ultimately decided to backstop all deposits at SVB to prevent systemic panic. But that's not guaranteed to happen next time. Before the FDIC was established in 1934, if your bank failed during the Great Depression, your money was just gone. Some depositors eventually recovered a portion through bankruptcy proceedings, but many lost everything. And money market funds? Those supposedly ultra-safe cash equivalents. In September 2008, the Reserve Primary Fund broke the buck, meaning shares fell below $1 after writing down its holdings of Lehman Brothers debt to zero. This had never happened to individual investors before. The money market, some $3.5 trillion in size, suddenly looked shaky. Investors fled. The Treasury had to implement a temporary guarantee program to stop the panic. Money market funds are not bank accounts. They're not FDIC insured. They invest in short-term corporate debt and other securities. If those securities default, you lose money. If you have more than $250,000 in any single bank account, you're gambling, period. Spread it across multiple banks, different ownership structures, or get the hell into safer assets. But we're not done. Two more things that reliably turn into nothing. Remember when I said physical real estate was a survivor? I also said leverage kills. Let me show you the difference between surviving and getting obliterated. From 2006 to 2012, there were approximately 8.7 million foreclosures in the United States. Millions of people lost their homes. Millions more went underwater owing more on their mortgage than the house was worth. If you bought a $500,000 house with 5% down, $25,000, and it dropped 30% in value, you now owe $475,000 on a house worth $350,000. You're $125,000 underwater. Can't refinance. Can't sell without bringing cash to closing. If you lose your job and can't make payments, foreclosure. Your $25,000 down payment, gone. Your equity, gone. Your credit, destroyed. Commercial real estate is even worse. Office buildings, retail centers, apartment complexes bought with massive leverage. When occupancy rates drop, when tenants can't pay rent, when property values collapse, when loans come due and banks won't refinance. Foreclosure, bankruptcy, total loss. Right now, commercial real estate is facing its own crisis. Office occupancy is down post-COVID. Retail is struggling. Billions in commercial mortgages are underwater. Professor Rebel Cole, finance expert at Florida Atlantic University, warned, banks are especially worried about regional and super-regional banks with exposure to depositors with holdings above the FDIC's $250,000 limit, and looming commercial real estate loan defaults may place added stress on these banks. They can't meet one of those runs if they have any unrealized losses on their securities portfolio, and they have commercial real estate loans going bad, Cole said. Then they'll have to mark that to market, and the regulators will close them. Real estate survives if you own it outright or with manageable leverage and can service the debt through the crisis. But if you're over-leveraged, or if you're in a property type that's facing structural decline, you're not surviving. You're getting wiped out. And now, the most ironic victim of banking crises. Let us end with the most delicious irony of all. The products that financial geniuses create to manage risk are often the first things to implode. Derivatives, synthetic CDOs, credit default swaps, interest rate swaps, structured products, inverse volatility ETFs, leveraged inverse ETNs, the stuff that requires a PhD to understand and seems brilliant, until it's not. Long-term capital management in 1998, a hedge fund run by Nobel Prize winners and bond trading legends. They used complex mathematical models and massive leverage. When Russia defaulted and markets behaved irrationally, their models failed. They lost $4.6 billion in a few months and nearly took down the entire financial system. In 2008, credit default swaps insurance against bond defaults became weapons of mass destruction. AIG had sold billions in CDS protection. When mortgages started defaulting, AIG couldn't pay. The government had to bail them out with $182 billion to prevent global financial collapse. Here's the pattern. The more complex the financial product, the less you understand what happens when things go wrong, the more likely it is to become worthless in a crisis. Inverse volatility ETFs? They can go to zero in a day. In February 2018, the Velocity Shares Daily Inverse VIX short-term ETN14 lost 96% of its value in one day and was terminated. Structured notes tied to bank solvency. When Lehman went bankrupt, structured notes issued by Lehman became worthless. Many of these products depend on counterparties' other financial institutions to pay out. If your counterparty fails, your hedge becomes worthless. In 2023, Credit Suisse's additional Tier 1 AT1 bonds were written down to zero as part of its rescue by UBS. Investors holding billions in these bonds lost everything. These weren't junk bonds. These were instruments from a systemically important bank, and poof, gone. The lesson: complexity is not sophistication, it's obfuscation. When crisis hits, simple assets survive, complex products explode. So what do we do with all this information? Let's bring this full circle and make it simple, because the pattern is actually incredibly simple once you see it. What survives? Gold, short-term US Treasuries, physical cash for liquidity. Not long-term storage, diversified blue-chip stocks. If you can hold through the pain, physical real estate with manageable or no debt. What goes to zero? Bank stocks, AAA, rated junk MBS, CDOs, corporate bonds, uninsured deposits, and money market funds. Over-leveraged real estate. Complex financial products. The pattern? Simple, tangible, liquid assets survive. Complex, leveraged, interconnected assets get destroyed. Assets that depend on other institutions remaining solvent, destroyed. Assets that depend on credit markets functioning? Destroyed. Assets that are so complex you need a computer model to value them? Destroyed. And right now today, as you watch this, we're sitting on all the same warning signs. U.S. banks hold $482.4 billion in unrealized losses. Commercial real estate is stressed. Regional banks are vulnerable. The Fed can't lower rates without reigniting inflation, but can't raise rates without killing more banks. You have a choice. You can position yourself like the survivors, or you can be the victim. The survivors hold gold, short-term treasuries, and cash. They have some quality stocks they can afford to hold through volatility. They own physical assets with manageable debt. The victims are all in on regional bank stocks. They're reaching for yield in high-risk corporate bonds. They have everything in one account above FDIC limits. They're leveraged to the hilt in real estate. They own complex products they don't understand. History doesn't repeat, but it rhymes. Banking crises happen every 10 to 20 years like clockwork. We just had one in 2023. Before that, 2008. Before that, the savings and loan crisis. The question isn't if another one is coming. The question is when, and whether you're positioned correctly. The 2008 crisis created massive wealth transfers. The people who held gold and cash bought assets from desperate sellers at fire sale prices. They got rich. The people who were over-leveraged, who owned bank stocks, who had uninsured deposits, they got wiped out. You can't control when the next crisis hits. You can't control whether your bank has $10 billion in unrealized losses hiding in its held-to-maturity portfolio. You can't control whether commercial real estate defaults cascade through regional banks, but you can control your portfolio. You can position defensively. You can be ready to deploy capital when opportunity strikes. The assets that survived every banking crisis since 1873 are still available today. Gold isn't going anywhere. Treasuries are one click away. Cash is in your bank up to FDIC limits. Quality stocks are on every exchange. Property is on every street. And the assets that go to zero? They're also available. High-flying tech bank stocks, complex structured products, over-leveraged real estate, uninsured deposits sitting in one account. History has shown us the pattern. The next banking crisis will follow the same script. The only question is which side you'll be on. The side that sees their wealth evaporate, or the side that survives. Choose wisely. If this video just changed how you think about your portfolio, good. That was the point. Hit that subscribe button. Until then, audit your portfolio. Check your exposure. Make sure you're positioned for survival, not destruction. Because the next crisis doesn't care about your retirement plans. It's coming whether you're ready or not. See you in the next one.